All right, so welcome to chapter 17, where we'll talk a little bit about standard costs, which we talked some about this in the budget chapters in chapter 15, 16. And then we'll introduce a topic called a balanced scorecard. So in this chapter, we'll describe what the standard costs are. We'll look at direct material variances. Again, it's very similar to chapter 16. We'll look at direct labor and total manufacturing overhead variances. And then we'll look at how to prepare variance reports and balanced scorecards. So standard costs help in a number of ways. They can help in planning activities. So when you have a standard cost for, say, a unit or a pound of raw materials, it helps you identify what is your expected cost, otherwise your standard cost, and then you can analyze your actuals compared to it. By having these standard costs identified, documented, and communicated to your management team and employees, it helps them understand and be more cost conscious. They can be aware of what things are actually costing. So for example, if you have somebody on a production line and they know the part that they are installing on this product that you are manufacturing, the cost say $10 and they waste one. They know, oh, I just lost $10, or I just cost the company $10 extra. It's helpful once you know standard costs in helping set selling prices. So if you have a process where your revenue is tied to your standard costs, you can say whatever my standard costs are plus 50%, plus 100%, whatever that might be. And item 4, we touched base already, is it helps evaluate cost control, helps identify any variances, unfavorable or favorable, like we talked in chapter 16. And standard costs help simplify cost of inventory. So for example, when you do your inventory accounts at the end of the month and you have 10 items of component A, and you know the standard cost is $10, 10 times 10 is $100, done. So a couple of things to identify is the difference between standards and budget. A standard is a unit amount. So it's per pound, per item, per whatever, versus a budget is a total amount. So your budget will look at the unit times the number of units that you multiply it by to determine budget. So again, from chapter 16, say your standard cost was $10 per raw material, you use 4 raw materials per product. So 10 times 4 is 40, and you have 1,000 available. So then you just do the multiplication accordingly. So standard is a unit amount, budget is total. When you're looking at setting standards, you want to make sure that anybody that has responsibility for those components are providing input, because then they're vested. They help understand, or they help drive what those standard costs are. They help determine what the quantities are needed to keep on hand and to be consumed by a production environment. So you want to involve them. Standards should be updated whenever managers that are responsible for that component determine that the existing standard is not a good measure. So maybe they've noticed, an increase in consumption, an increase in, average price in buying those raw materials. Then they might come back and say, you know what, finance team, my standard unit price has gone up to $12 from $10. So the managers should be involved in helping adjust those standards over time. There's typically a couple of levels of standards in a company. There's what we call ideal, which is the optimum level. So under normal operating conditions with normal waste or normal consumption, you have an ideal standard. Sorry, not the word normal, don't confuse that. Sorry, ideal is optimum, so what you strive for. Normal is what you typically get. Sorry, that's right. So normal is what you typically get. So if ideal means you need 4 pounds of raw materials for this item at $1.50, so $6 per item. But normal, you have about a 10% waste because of evaporation or employee spill or whatever that might be. So normal might look at the 4 units, add 10% for the waste. So your normal might be 4.1 units instead of 4 units. And you want to make sure that both standards are attainable or achievable. Is it possible to get to those levels? Because you don't want to put people in a situation where they can never achieve the standards. So a little question, normal standards. Which question do they meet? A, B, C, or D? So A, do they allow for rest periods, machine breakdowns, setup times? Do they represent levels of performance under perfect operating conditions? Remember, this is normal, not ideal. Are rarely used because managers believe they lower workforce morale? No, they should be used. D, are more likely than ideal standards to result in unethical practices? No, because ideal is where it might be unethical, because ideal is the best. So normal, I would say, is option A. They allow for rest periods, machine breakdowns, and setup times. So ideal may not allow for those rest periods, but normal would allow for things such as that. So now talking a little bit about direct materials price variance. So price standard is the cost per finished unit of direct materials that should be incurred in your production environment. So a standard direct materials price per pound in this example, what if we have the purchase price net of any discounts, $2.70, cost us 20 cents per direct material to get it shipped here and 10 cents for receiving and handling. So we're saying our standard direct materials price per pound in this case is $3. Next, let's look at the direct materials quantity standard is the quantity of direct materials that should be used per finished good. So we know that an item in this example requires 3.5 pounds. We have a waste of 0.4 pounds on average, and then we might have some spoilage of 0.1 pounds. So our direct materials quantity standard is 4 pounds. So therefore, our standard direct materials cost is the 4 pounds times the $3 from the previous slide here, standard direct materials price per pound. So our standard direct materials cost would be $12 per finished good. Little question then, direct materials price standard should include an amount for all of the following except which one? So receiving, yeah, we talked about receiving. Storing, yes. Handling, yes. Normal spoilage cost. Remember, this is the price standard, not the unit standard. So it would not include normal spoilage. Spoilage comes into the quantity, not the price piece. The direct labor price standard is the rate per hour that should be incurred for direct labor. So we have an hourly wage rate of $12.50. COLA, C-O-L-A, stands for cost of living allowance. I'm not sure why they put it in here, but they did. So they put in a, what is that, a 2% COLA, 25 cents. Payroll taxes seems pretty low at 75 cents. That's your CPP, EI, et cetera. Fringe benefits, maybe that's, healthcare plan, whatever that might be, or time off. So our standard direct labor price per hour in this example is actually $15. The employees are only getting paid $12.50 directly, but there's other costs to have employees. Then looking at the quantity is the time that management thinks is required to create that 1 unit of product. So we actually have production time of 1.5 hours in this example. There are rest periods, and you need to keep a clean environment. There's setup and downtime, some machines break, you need to warm up machines, whatever that might be. So our standard direct labor hours per unit is 2 hours times the $15 direct labor price per hour, gives us a standard direct labor cost of $30 per finished unit of product. Excuse me. Manufacturing overhead, companies typically use a predetermined overhead rate in setting the standard. So how they typically come up with this is looking at the budgeted overhead cost by the expected standard activity. And that could be direct labor hours, it could be machine hours, it could be finished goods. So they look at what's the overhead to operate this unit. And that could be depreciation, it could be a supervisor's salary, it could be insurance, things like that. Add it all up, that's your overhead divided by one of these key drivers. So a little example then again is we have standard direct labor hours as our activity index. We think we're going to produce 13,200 gallons during the year, and it takes 2 direct labor hours for each gallon. We're told what the variable and fixed overhead costs are. You can see it on the screen here. Our standard direct labor hours, we take our 13,200 gallons times 2 hours each. So we're expecting 26,400 direct labor hours as our standard. So therefore, our overhead rate per direct labor hour, you divide the two. So we'd have a total of $5 manufacturing overhead per direct labor hour. Therefore, our standard manufacturing overhead rate per gallon is the $5 times 2 direct labor hours for each gallon. So for every gallon of whatever product we're making is produced, will cost us approximately $10 in standard pricing for manufacturing overhead. So a little example then, put it all together. So if it takes 2 direct labor hours for each gallon, we're making 13.2 over the year. We have direct materials. We have 4 pounds at a standard price of $3 is 12. With direct labor, 2 hours at a standard price of 15. So this is pulling all the slides that we've covered so far today. And then we have a manufacturing at 2 hours at 5. So our standard cost per gallon of this exotic tonic is $52. That's our standard cost. I don't know what this is, but $52 a gallon. All right, let's change scenarios for a second. We want to look at Redette Inc. They accumulated the following standard cost data for this product. They have direct materials per unit, £1.50 at $4, direct labors, 0.25 hours at 13, and manufacturing overhead, $15.60 per direct labor hour. And so we're asked to create the standard cost of 1 unit. So direct materials, £1.50 at $4, direct labor, 0.25 at 13, and manufacturing 0.25 because it's using per direct labor hour at $15.60. So our standard cost for this unit of product CTY31 would be $13.15. All right, so now let's move on and talk about direct materials variances. And so just like we did in chapter 16, whenever you look at actual to either budget or in this case, actual to standard, if actual is less than your standard cost, then you have a favorable variance. Your costs are less than you expected. And if they're bigger or greater than standard costs, you have an unfavorable variance. It's the same kind of approach that it is actual to budget. And then once you've identified favorable or unfavorable, you need to look at, what are the underlying factors? Why is it favorable or unfavorable? So a quick question then, a variance is favorable if actual costs are, which one? Less than budget, less than standard, greater than budget, greater than standard. And remember, this chapter is about standard. So it's either B or D. And if it's favorable, that means actual is less than standard, because our standard costs, our expected costs were greater than what we actually incurred. Little illustration here. Assume that in producing 1,000 gallons of that exotic tonic in the month of June, they incurred the cost of the right. And if you remember, our standard cost was $52 per gallon. And we'll do a little analysis. So we pull in our actual at 55,000. Our standard cost at $52 per 1,000 gallons is 52,000. Therefore, we have a variance where actual exceeded standard by 3,000. So we have an unfavorable cost total variance. Now that we know what the total variance is, there are different components in here that drive that variance. There could be a materials variance. How much more money did you spend on materials? A labor variance, and an overhead variance, and that determines your total variance. And because you have standard pricing and standard expected quantities, you can actually break that down into a price variance, because your price per unit changed, or did you use more or less quantity? So you might have a quantity variance or a price variance, and that gives you your total materials variance. So let's look at the total materials variance. So this is the bottom number in this little chart here. So we're going to start here and work backwards. So in order to complete the order for 1,000 gallons of the exotic tonic, we used 4,200 pounds of direct materials. They were purchased 310. Standard price was 3. So we look at our actual quantity, actual price, 4,200, 3 times 310, plus the standards, 4,000 times $3. So we had a total unfavorable materials variance of 1,020. So now we want to break out what was the price variance versus what was the quantity variance. Because if you look here, you have actual quantity, actual price, standard quantity, standard price. So we want to separate these. Oops, sorry, scroll right here. So the materials price, how you see this is you always want to keep one variable consistent. So we will keep our actual quantity the same. And now we just want to determine the difference in price. So our actual price times the actual quantity plus the standard price times the actual quantity. So you can see our 4,200 consumed quantity stays the same. And our price is different at 10 cents more in one case. So we have a $420 unfavorable price variance. Moving forward then, let's look at the quantity variance. So in this case, we want to keep our standard price consistent. And we want to look at the difference in the quantities. So we have 4,200 units, actual, times $3. 4,000 planned, times $3, gives us a $600 quantity variance. So then if we add our price variance of 420 unfavorable, quantity variance of 600 unfavorable, we'll get our total materials variance that we identified 3 slides ago of 1,020 unfavorable in total. So we've now split it between price and quantity. So just to visually put this together then, but based on that chart from about 4 slides ago, with our total materials variance split between price and quantity. And where that comes from is from these 3 calculations at the top: actual quantity, actual price, actual quantity, standard price, and standard quantity, standard price. It's very helpful in understanding what is the driver of your variance. So if it's a price variance of $420, did the vendor that you buy from increase the prices? Did we have to pay more in freight? You can do some analysis to determine that. On the quantity, are you spoiling more? Or are your finished goods taking more for whatever reason? Or are you reporting incorrectly? Or is there theft going on? So factors that might affect the price paid, I think I actually touched a little bit on it. How many cash discounts are you getting, if any? What's the quality of the materials? What's the delivery method? On the materials quantity, again, was it faulty machinery? Was it inexperienced workers? Did they throw away stuff that they shouldn't? So you're using more quantity than you should? And those are some of the potential causes. So a little example then, standard cost of Wonder Walkers includes 2 units of direct materials, $8. During July, the company bought 22,000 units of direct materials at $7.50 and uses those materials to produce 10,000 Wonder Walkers. Compute the total price and quantity variances for materials. And therefore, first of all, we need to know the standard quantity. So for 10,000 units that take 2 units of direct materials each, our standard quantity should have been 20,000. So I'm thinking about our formulas earlier. We look at our total materials variance would be our total materials, actual 22,000 times the actual price, $7.50, less the standard at 20,000 times the standard at 8 equals 5,000 unfavorable. We actually spent more on materials. Now we want to break that down into price and quantity. So price, we want to keep the total units to actual, 22,000 and 22,000, and only have the price change between the two pieces, $7.50 and $8. So we actually had an $11,000 favorable variance because we actually paid less per unit. On the quantity side, we want to keep our standard price at $8. And we want to look at the difference between actual and standard quantities consumed, 22 and 20,000. Therefore, we have a $16,000 unfavorable quantity variance. So it tells me here, hey, we did a great job in our pricing, but we consumed a lot more quantity of direct materials than expected as per the standard. Again, did we waste too much, etc. So let's move on to the direct labor and total manufacturing overhead variances, all similar to what we just did. So determining the direct labor variances, it's actually the same as direct materials in this case. So total labor variance is the difference in the amount actually paid versus the amount that should have been paid. So same kind of function, actual hours, actual rate, standard hours, standard rate. So in this case, we had an actual of 2,100 hours at $14.80. Our standard was $15 per hour and 2,000 hours were expected. So we have a labor variance of 1,080 unfavorable. So again, we can break it down to be between what we call price or the hourly rate difference and the quantity of the labor hours. So let's start with the price. So we'll keep our actual hours the same, 2,100. And we'll look at the difference between the actual rate and the standard rate, 14.80, $15. So we actually have a labor price variance of $420, favorable. Breaking down the quantity, actual hours times the standard rate, standard hours times the standard rate. So we had a $1,500 unfavorable variance for the quantity of hours consumed. Little table on the bottom right here says we have 420 favorable on price, 1,500 unfavorable in quantity. Then we tie into the 1,080 unfavorable total direct labor variance. Again, a little table that shows how it all ties in. I won't go over it all again. You can always pause and take a look at it. Some of the potential causes, price variances, maybe you're paying workers different wages than you expected. Maybe you have younger workers versus more senior workers than planned. Okay. Sometimes you might put the wrong people on work, so maybe you're paying more or less than you should. So it's up to the manager to make sure that the right people are in there. On the quantity, typically it talks about the efficiency of workers. So are they taking just too long, taking too many breaks, too many sick days compared to plan, whatever that might be, or not enough if you're favorable. Overhead. So overhead variance is the difference between actual and overhead costs applied to the work done. So it's actually, is comprised of a variable and a fixed component. So we're told our variable and fixed actual costs here, and we have 10,900. The predetermined overhead rate was $5. So the formula for total overhead variance would look at the actual overhead of 10,900 times the overhead that should have been applied, $5 times the 2,000 hours expected. So we had a $900 unfavorable total overhead variance. Now, typically you want to analyze it through a price and quantity variance. So the price variance looks at the controllable variance and how effective were you in controlling those overhead costs. The overhead volume variance relates to whether fixed costs were under or over applied during the period. So based on your actual production, were they charged appropriately? Various causes might be, indirect labor, electricity costs, maybe your utility costs went up faster than expected or dropped. Maybe you didn't maintain the machines properly, so you incurred more maintenance than expected. Maybe you didn't have enough sales orders. Little example then, let's look at the standard cost of product YY, includes 3 hours of direct labor at 12 bucks an hour. The predetermined overhead rate is $20 per direct labor hour. During July, the company incurred 3,500 hours of direct labor at an average rate of $12.40 and $71,000 in manufacturing overhead costs. And it produced 1,200 units. So the first step is we're asked to compute the total price and quantity variances for labor. So A, we look at the actual direct labor hours times the average direct labor rate per hour. So we have our total spend. We have our units produced. We have our standard direct labor hours per unit. Therefore, our standard direct labor hours times the standard direct labor rate will give us our standard or expected direct labor cost of $43.2. So we actually spent $200 more in actual than we expected. On the price variance side, let's look at our actual direct labor hours times the average direct labor hour paid and the standard direct labor hour paid. So we had a $1,400 unfavorable variance due to price because we paid more per hour. On the quantity side, we look at the standard. Okay. So the standard quantity versus the actual quantity used. Go through the formula accordingly, just like we did earlier. And we have a $1,200 favorable variance. So we used less than expected in the hours. You see 3,500 hours here versus 3,600 hours. Next part says compute the total overhead variance. So our manufacturing overhead costs, we're told were $71.3. To get what we expected, we take the 1,200 units produced, our standard direct labor hours per unit 3. So we have 3,600 as our total standard direct labor hours expected. We're told our predetermined overhead rate per direct labor hour was $20. So our expected total overhead was $72,000. Therefore, we had a favorable variance in overhead of $700. All right, let's move on to variance reports and balanced scorecards. So variance reports, you always want to report them to the right levels of management. So if it's a variance report for a department, it'll go to the department manager and above. If it's for a specific unit, it goes to that unit manager. If it's for the entire plant, it'll go to the plant manager. The frequency, the form, the look, and the feel of those reports might vary a little bit based on the reader, so based on what those managers need to see to understand. And typically, there's a principle of what we call management by exception. So as long as things are going well, typically it's more of an FYI, and if they have things to say, great. Otherwise, you focus on the unfavorable components. And then typically management looks at what we call significant variances. So if you're out, a couple of bucks or almost 0% on, say you got $1 million spend and you're out by $100, you probably won't worry about it. But if you had a $500 budget and you're out by $100, you're going to worry about it because that's a 20% variance. So you'll have to set standards for what is considered a significant variance. Okay, so this is a little example like we did earlier. So we had the total price variance of 420, and then you'll have more details when it comes to the purchasing department. So maybe they'll look at, each specific order and determine, where did that come from? And in this case, there was a rush order. So we put a rush on somebody to get, this 4,200 pounds of materials to us for whatever reason. So we can explain why there's a price variance. So these are all backup reports to what we calculated earlier today. Now, under the standard cost accounting system, the cost of goods sold is always stated at standard cost, and the variances are disclosed separately. Okay, and we're going to pull up a little example. So in Exonic, where they have a standard cost, $52 per gallon, and say they had $70,000 of revenue, their standard cost of $52,000, they had a gross profit at standard of $18,000. And then we can pull in all the variances. They had a materials price variance, quantity variance, labor quantity, overhead variance, and you see unfavorable versus favorable. So total variance unfavorable is 3,000. So therefore, the cost of goods sold were actually greater by an additional 3,000, but we've identified it separately. So for our gross profit on the actual side is 15,000, and let's just assume 3,000 of selling admin, so net income of 12,000 bucks. So we just made some other assumptions. You can see how this is helpful to the management team. So a little question, which of the following is incorrect about variance reports? They facilitate management by exception. No, we said that's true. They should only be sent to the top level of management. That sounds wrong. Let's come back to that. They should be prepared as soon as possible. Yeah, you want timely statements. They may vary in form, content, and frequency. Yeah, we said that's true. So therefore, B is the only one that's incorrect. Let's move on to balanced scorecard. So balanced scorecard looks at typically 4 areas or more of the organization, and the most commonly areas are finance, customer, internal processes, or learning and growth. So when you look at balanced scorecards, these are the 4 most common, but you might, if you work for someone else, have it broken down in a different manner. So balanced scorecard looks at performance of a company and the relationship of that performance to the company's strategy. So the company has a strategy, to grow sales, to, gain a new customer base, to improve processes in a certain area of the business, or to improve professional development of their employees, just as an example. So a balanced scorecard then evaluates a company's performance on other perspectives. So it's not always just finance. It could be finance pieces, but maybe there's other statistical components. And they talk to each other. And that's why it's considered balanced, because at the end of the day, it's all talking about the business. So some of the non-financial measures that are used in industries, so in the auto industry, perhaps they measure the capacity utilization of plants. What's the average age of their assets? What's the impact of any strikes? Computer system companies, how many new products do they have? How much R&D are they doing? Banks, numbers of ATMs, personal cost per employee, whatever that might be. So these are just some examples of non-financial measures that are used for balanced scorecards. You might look at employee turnover. You might look over employee retention, the average number of years that an employee stays with you, things like that. So then let's look at, breaking it down on these 4 kind of common areas: finance, customer, internal, process, and learning and growth. And these are just examples. In finance, you might have an ROA, return on assets. You might have net income, your share price, your profit per employee. Customer, retention, brand recognition. I'm just reading out some, but you can read the rest. Internal process, what's your waste look like? How many defects? How many training hours are there under learning and growth? How many people are leaving in less than a year or staying for more than 20? Things like that. It all gives you an idea of how the company is performing. And then you would set targets typically, or benchmarks where you want to be. So a little question then, which of the following would not be an objective used in a customer perspective of the balanced scorecard? So remember, then the customer section, percentage of customers who would recommend product to a friend. Yeah, customer. Customer retention, that's customer. Brand recognition, well, you'd only find that out by customer. Earning per share, that's not customer. That has to do with finance. Oops, I jumped, I apologize. All right, a little summary on the balanced scorecard then. Typically employs both finance and non-financial measures. So it'll pull in net income, earnings per share, things like that, but it'll have other metrics as discussed. It creates linkages to the corporate goals. You know, where do you want to go? So that way the shop floor and people working in the business, the management team, et cetera, understand how it drives the strategy of the company. It provides objectives for non-financial measures, and it integrates all the company goals into a single performance measurement system. So it helps pull in all the various goals, finance and non-financial, into one card. And hence it's called Balanced Scorecard. So we have another example here. It looks like, don't know why this fits in here, but anyhow, we have this company experienced the following variances and we want to determine actual gross profit. So we have our sales revenue 1027, we're told. Cost of goods sold at standard 619. We have our various variances. So total variance, and we have to add this up and we'll determine that it's a favorable variance. So our gross profit actual is slightly higher than our standard at 42,550. All right, I think this is our last learning objective for this chapter. So it's looking at overhead controllable and volume variances. So typically overhead variances are analyzed through price and a quantity variance. So just like we look at the other components. And overhead controllable variance on the price variance determines whether we've effectively controlled our costs, versus volume relates to whether fixed costs were under or over applied. I think we had this slide earlier. Overhead controllable variance, you know, did we control them well? So how we look at this is we look at our budgeted costs for standard hours allowed. So budgeted costs are determined from the flexible manufacturing overhead budget, like we did in chapter 16. So let's look at this little example, excuse me, where the manufacturing overhead for variable manufacturing costs was $3 per hour of labor, plus fixed manufacturing overhead costs of 4,400. So our standard direct labor hour costs, we have different activity levels, but we're expecting 2,000. So this red column here would be our standard expected manufacturing overhead. So for our budgeted overhead, based on standard hours allowed, would be 10,400 in total. I'll go back, 10,400. Versus our actual overhead based on the number of slides ago today was 10,900. So we had a controllable variance of $500 unfavorable. Actually spent more than expected. Now looking at the overhead volume variance, we looked at the fixed overhead rate times the difference in normal capacity hours less the standard hours allowed. So in this case, we have budgeted fixed overhead costs for the year of 52,800. Normal capacity, that was 26,400 direct labor hours. The fixed overhead rate was therefore $2 per hour. 52,800 divided by 26,400. We produced 1,000 units of tonic in June. The standard hours for those 1,000 gallons is 2,000 because every gallon took 2 hours. For Zonic, normal capacity for June is 1,100. So standard direct labor hours for June at normal capacity is 2,200, which is our standard of 26,400 per year divided by 12 months. So we're asked to compute the overhead volume variance. So our fixed overhead rate was $2. Our normal capacity is 2,200 per month. Our standard hours allowed were 2,000. So therefore, our volume variance is an unfavorable of $400 because we didn't use up to our normal capacity. Volume variance is unfavorable because we produced only 1,000 gallons versus 1,100 gallons. So we didn't produce as much as we could have. And last slide in summary, in computing overhead variances, it is important to remember which, and actually not which, all of these, sorry. Standard hours allowed are used in each variance, so you always want to use your standard. Budgeted costs for controllable variance are derived from the flexible budget. So for the controllable variance, you look at your flexible budget versus based on what was expected. The controllable variance generally pertains to variable costs because you can determine how much you consume. And volume variance pertains solely to fixed costs. So fixed costs, the only ones that have the volume variance. And that's it for chapter 17.